Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike
Zlotnik, and today it is my distinct pleasure and a privilege to welcome my good friend, Paul Moore. Hi, Paul.
Hey, Mike. Great to see you again.
Welcome back on the show. This is your second appearance, and I'm honored and humbled. You're a great friend. Your brother from the Collective Genius Mastermind. We have many mutual friends. So I'm grateful for you to come back on the show. Tell us a little bit about what's new in your world. How's family? How's everything there? And what's new in business?
Yeah, well, I got 3 good kids and this other kid. No, I'm just kidding. I say that to irritate my youngest. Anyway, now I've got 4 kids. They're doing great. Wellington Capital is launching our 5th fund. And my new book called Storing Up Profits, which is a book on self-storage, was just released by Bigger Pockets Publishing yesterday. And so it's of my 3 books, it's the first one done by a major publisher. So I'm pretty excited.
Oh, congratulations. Yeah, Bigger Pockets is a big name. So that's great that they published your book. So why did you write a book about storage?
So I wrote a book about multifamily investing, and I humbly titled it The Perfect Investment back in 2016. And I thought that multifamily was the perfect investment. I really believe that. But you know what? The perfect investment isn't perfect if all the deals are 10 or 20 or more percent overpriced. Inflation may save the day for all those guys who are overpaying. But if it doesn't, I would consider that a speculation in a sense. I mean, if you have to have future rent growth, and if you have to have certain things happen in the economy just to make a profit, there's a little bit of speculating involved. They say investing is when your principal's generally safe and you've got a chance to make a profit, and speculating is when it's not really safe and
Benjamin
got
Graham,
a chance
to
make a profit. Yeah, you remember that. That's right.
Speculation, investment is an operation which the safety of principal and a reasonable rate of return, everything else is speculation. Something like that, the language goes.
Yeah, something like that, right. And so, Mike, I actually got really worried. I know I don't look it, but I'm in my mid-50s, and you're thinking, he looks like he's in his 70s. But
let's say it's not the year, that's the mileage.
Yeah. So anyway, no, seriously, I didn't feel like it was right to take our investors' money and my family's money to plow into speculations. Look, I did that already. I remember I had a podcast you were on called How to Lose Money. And that was no fun. You were on there, right? Yeah.
A long time ago, but I do remember appearing on your podcast. And
that was like 4 years ago. Yeah.
That's a funny name. Yeah. It's usually how I do the podcast, How Not to Lose Money, but I guess you do the podcast, How Do You Lose Money?
Yeah, right. Well, we were trying to warn people about not speculating and all that stuff. But anyway, so we didn't feel like it was right to plow money into stuff that we, thought was overpriced. But then when we discovered mobile home parks and self-storage, we didn't feel like it was right to have our investors hand us millions of dollars for something we had never done ourselves. And so, Mike, like you, we found that the best path forward for us was to be a diversification specialist and a due diligence partner for our investors. Our goal, like yours, is to find the very best operators we can and then invest heavily with them. And so that's what Wellington Capital and our funds, that's what we do.
Yeah, so these are great points. I certainly am a big proponent of diversification. And some people crack a joke about diversification. Diversification is for those who can't find great deals. But I'll beg to differ, having been a fund manager for many years now. You just never know what's going to be a big success and what's going to be a complete strikeout. And
I hear you.
The only way you can do is you can diversify to spread the risk among multiple projects. But of course, you got to be the best access point. You have to do the due diligence, and that's what the fund managers get paid for, right? We got to find the deals that are strong deals, not just an average deal. Investors can find average
Right.
deals themselves. So it makes sense.
Yeah.
But
Yeah.
why? Let me just jump into this very quickly. So you just came forward firing some shells at the multifamily and giving your love to storage and mobile home parks. Do you really think today storage and mobile homes are in general not overpriced, while the multifamily, on average, in general, are overpriced? Is that what you're feeling today?
Actually, I think they're all three overpriced. So why do I like these two asset types? By the way, I never answered your question about why I wrote the book. Maybe we'll get back to that. Anyway, the reason I think self-storage and mobile home parks can be different is that a whole lot of them, as much as 85% of mobile home parks and about 50% of self-storage, are owned by mom and pop operators. And that means they don't have the desire, the knowledge, or the resources to upgrade, to increase income, and to maximize value. And when you can find those wonderful jewels, those assets with intrinsic value waiting to be harvested, that's where you get the tremendous upside. So when the company we invested with paid $7.1 million for a mobile home park in Louisville almost 2 years ago, they were paying a high price. But when they sold it 10 months later for $15 million, well, it turned out good. And the reason they were paying a high price is, honestly, it was so poorly run, and the owner hadn't even visited the place in over 5 years. So, it was so poorly run that for the dollars of income at the time, it was a good price. But after he improved it, it took him only 6 months to get the place humming beautifully and make a better place for the residents. And he sold it for that. 347% IRR, Mike. Where do you find deals like that in multifamily right now?
Well, it's definitely hard to find. So what you just described, what I just heard, is a classic value add, where you can't look at a cap rate you're buying, you're paying for it because it's under performing, it's under managed, right? That's the whole drill. You could buy it at a low cap rate when the property is badly undermanaged, and just increase the operational efficiencies, increase rents, clean up and improve. And before you know, you could turn the thing around at a substantial profit because of the value at work. So it's not really, the value was there. The opportunity was there. So that deal makes total sense. And I guess that's your champion that beats my champion. We just had a deal exit in the hotel to multifamily conversion with 140% IRR. I thought that was a home run. You just gave me an example of a bigger home run.
Wait, was that in Virginia Beach?
That was in Winston-Salem, North Carolina.
Oh man, good for you. Well, that's fantastic. Look, I actually, okay, I'm going to say something here. I hope my friend who operated this Louisville deal is not listening. I don't think he should have sold, because I can show you math for how he could have got it to 20 million in about 4 years. Would you rather have a 347% IRR in 10 months? Or as an investor, would I rather hold on for 5 years, make 15-20% cash flow a year, and then exit for even much, much higher? I wish you would have held on.
Well, that's a great fundamental question. Now we're going to dive into a little bit of an area, a little deviation, but great that you mentioned this, because I love this point. So I've had this conversation many, many times. Would you rather refi upon completion of stabilization or a substantial completion of the value at work, and then hold the property for 5 years or longer, or flip it for a greater IRR? So I would love to hear your perspective. Let me just finish the thought here. The concept is obviously very powerful. The reason people flip, in theory, right, is that you have another great place to put the money to maintain the momentum, right? If you don't have anywhere else to put the money, then why sell? That's a pretty obvious driver. But can you think of any other justifications when to sell or why to sell versus when and why to refi and to hold? Just would love to hear your thoughts on this.
It was a great PR stunt. It wasn't a stunt at all, by the way, but it was a great PR move for him to get a 347% IRR. His typical IRR, by the way, is 40 to 60%. But I would have rather seen him get a 50% IRR, which is what, 1/7 of what he got, 1/7, and hold it for 10 years. Because here's the thing, if he's got fixed low interest debt, which many of our operators do, actually, I think they all do, and they can hold it and capture inflation, well, that's a really beautiful thing. So a mobile home park captures inflation every year, on an average 1-year lease. Some industrials, Mike, you know this, they have a 20-year lease already signed with Amazon or whoever, or a big factory or whatever leasing. They can't capture inflation very well unless it's built in with a escalation clause for inflation. Look at self-storage at the other extreme. We can capture inflation every month because every lease is a month-to-month lease. And a tenant paying $1,000 a month for an apartment might get irritated and move for an 8% rent increase, which captures inflation. But a self-storage tenant at $100 a month is probably not going to spend a weekend, rent a U-Haul, get his friends together to move his his treasures down the street to save $8 a month. And that's one of the things we love about self-storage. So I wish he would have refinanced, given us our money back and redeployed some maybe, and then held on. But who's complaining? It was a great return. And he's got a bunch of deals like that, to be honest.
Well, certainly there's nothing to complain about when that IRR comes in on a short duration flip. I've seen this again through some of the recent exits we have seen already. Generally speaking, it's a great, again, PR, and then it's a great also way to get the cash back and redeploy if you have new set of strong deals. So I would continue to I would support the sale event when you have great deal flow, and quick flip just gets you the cash, and then you can redeploy.
That's a great point.
The other drawback of obviously sale is you get to recapture depreciation, you get all the profits, capital gains. You basically have to deploy into the new deals, do new cost segs. Obviously, mobile home parks are uniquely good for cost seg. But as long as the money can be rolled forward without tax implications, or at least with tax deferral, then it may not be such a bad idea. But I can tell you this, we have a very strong project, and I spoke with a sponsor, very similar situation, multifamily. He executed half of the value add between a project that was acquired in June 2000, and about a year later, he had an offer above pro forma of 5 years, having spent only half the money. And I spoke with a sponsor.
Wow.
And that's wow, exactly. It's a good execution plus the market, right? The market,
right,
from depths of COVID, right, to a year later, has appreciated quite a bit. So it was really interesting. The conversation was, do you basically flip and do something with the money, or you refi? And the decision was to refi, finish the value add, increasing the value substantially further, and your IRR comes down, but your overall utilization of the money improves. I mean, this is the other concept: is the money coming back burns a hole in the pocket. So keeping the money in the deal, in a great deal, there's nothing fundamentally wrong with this. And like you said, upon stabilization, get a great cash flow of 15%. People not going to complain in general, right?
Yeah, Sam Zell said that he made a lot of his billions in the 70s, late 70s, early 80s, with low interest rates of only 7 to 7.5%, and holding on while inflation did its magic. And so we are here, with interest rates less than half of that now, 5,000-year lows, historical interest rates. What a great chance to build wealth, even if some of it's nominal in name only, with inflation, chewing away at the value of the dollar. But, the commercial real estate investments that we have a part of, Mike, we're truly blessed.
Yeah, by the way, I'm going to go back and obviously support your comment on the storage. We do like storage quite a bit. We have quite a number of investments in storage ourselves. And one of the major benefits in storage is that flexibility to raise rents on a monthly basis.
It's powerful.
If the demand is, if you see the occupancy is up, the demand is high, you could easily move the rates for everyone. The next month, it's a monthly rent. Just to conversely, just to be very clear, there are risks. It's not a perfect world.
Right.
We've seen markets where there's oversupply. When there's oversupply and there's heavy saturation, the rents could drop because so much supply.
Terribly. I just wrote an article called 5 Downsides to Investing in Self-Storage. It's not out on Bigger Pockets yet, but one of them, the number one risk by far, is during your lease up, when you're going from 0 to stabilized, a big national competitor comes in down the street. They can literally drive you out of business and then buy you for a song.
Yeah, that is a danger zone, and it's good that we mention it for folks. So let an average investor or a great investor think and understand there's risk. There's a risk, and if the market gets oversaturated, you can take it on the chin big time. But in general, in normal cities and towns without massive competition, this is an awesome asset type that is a great hedge against inflation, to say the least.
Yeah. And you asked me why I wrote the book. I mean, we love self-storage, and I'm looking at my bookshelf right now. I ordered about 5 books on self-storage when I first heard about it years ago. And I was disappointed with every one of them. One of them was okay, but it was a niche type marketing book. They were kind of self-published, and I've self-published before, and I've had errors in my book before, so I get it. But at any rate, we decided to write a new book on self-storage, and Bigger Pockets picked it up, and it was delayed 1.5 years from COVID. But guess what? Wall Street Journal and New York Times just did stories, big stories about self-storage just taking off amidst and after COVID. And so actually, I think the timing was just providential.
Yeah, people got to store their treasure somewhere. At the end of the day, at some point, like everything else, the asset class is going to get sort of oversupplied, and some markets have already been oversupplied. So this is now no longer throw stuff and see what sticks on the wall. It is a surgery. Right. You have to be precise. You have to really do your due diligence in your studies and see what is the market, what's the barrier to entry. Do local municipalities welcome or absolutely hate any more conversions of old retail to storage and so on? But in general, it's a great asset class. So let's continue to talk about your new fund. So you're launching brand new fund. Talk a little bit about that. If I understand it correctly, you're going for the first time with the essentially registered fund, and you're becoming an RIA. So why go that path when you can launch 506c fund? And
how many hours do you have?
How many what?
How many hours do we have to talk about this painful decision?
We only have like 7 minutes left. So
okay, I'm just kidding.
Give me the executive summary. I know it's a hard. But it's going to be a really cool fund. So just tell a couple of things about this fund and why you're going through the pains of making it a registered fund.
So we're going with a semi-evergreen or evergreen type fund that's going to be open for years for investors to come in and even possibly have liquidity out of. That's one thing we wanted to offer that we weren't offering before. Another thing is, as a non-general partner, we were not a co-GP on our deals, and we didn't really want to be. We were actually running a little bit of risk that the SEC would come in and say, hey, you're not a co-GP. And so we think that you need to, you shouldn't be doing this or that or the other. So we actually, our last 2 funds are one that we just finished a month ago, and the one we're starting about the next month are actually 3C1 funds. They're 506C. They're also 3C1 in the sense that the number of investors are limited to 100
people. Yeah, I aware of that limitation. That's not a fun limitation. We have to deal with it too. Limits you in how many people you can take into the fund. You have to close the fund to new people once you reach that 100 people.
Yeah, and so we were actually only, a few weeks into our fund, and we had raised 60 of the 100 came in. Well, what are we going to do the rest of the year? So we decided we really wanted to get something that would be open for much longer, Mike. And we also wanted to be able to work with accredited investors. The 3C1 fund structure that we chose to do limited us to what's called qualified clients. That's not qualified purchasers, but 2.2 million net worth. We didn't want to do that. We wanted to go back to accredited. And so this is why we decided to go with a registered fund. There's a lot more involved here, but that's the gist of it, my friend.
Makes total sense. I'll make this comment. We're working on our Tempo Growth Fund too. And that's literally, we had a discussion with the attorney about this, and we're going with 3C1 qualified clients for the reasons that it's easier and simpler, but we're limited to 100 investors. So the universe and the life cycle of that fund is shorter and smaller, but that's why you do a closed-ended fund. For an open-ended fund, which you envision, you're absolutely right. That structure may be the best structure for you, but it's compliance. I wish you absolutely the best success. You're going to have to deal with all the compliance and regulatory requirements reporting, and there's nothing fundamentally wrong with it. It's just an overhead.
We're literally hiring extra staff for this, and we're hiring an outsourced, CTO, chief compliance, or CCO, chief compliance officer, et cetera. So there's a lot involved, but that's what we're going to do. And we're really excited about working with you on some debt options down the road. I hope we can partner together on that when we get this up and running.
Yeah, makes total sense. Good luck with that fund. Launch successfully, run well. And so we have 3 minutes left. So final thoughts, comments. This was great. We'd love to have you back. But in the last 3 minutes, what are sort of the message you wanted to send to folks? Wisdom, what's the best way to get a hold of you?
I spent years trying to figure out how to get into commercial real estate, Mike. I was flipping houses and lots and did a subdivision, and I've tried to make it as easy as possible for others to learn more about that. So they can go to, they can get my new book, Storing Up Profits, Capitalize on America's Obsession with Stuff by investing in bigger pockets, by investing in self-storage. And that's at biggerpockets.com/storage. And if they want more information about how to get involved in commercial real estate investing, self-storage, mobile home parks, et cetera, they can go to wellingscapital.com/resources. And we've got all kinds of stuff on there. I would say if you want to invest in self-storage, but you don't want to be hands-on, this book will really help you know how to evaluate a deal. If you want to be hands-on, you want to start your own facility or renovate an old Toys R Us like my friend did and got a huge return, you can learn about that, at least the introductory thoughts on how to do that kind of stuff in my book as well. So Mike, thank you for giving me a chance to chat with you today.
Paul, appreciate your wisdom, and thank you for all your sharing. And storage is a great asset class, and for the folks, Paul is a specialist, and learn from the best. And again, go to biggerpockets.com/storage, right? That's the website.
Yeah, that's right.
Thank you all very much. Looking forward to have you back. And we're recording this before Thanksgiving. I don't know when it's going to air, probably soon. So happy Thanksgiving.
Same to you, my friend.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.